Okay, welcome to the Chapter 4, Transactions that Affect Assets, Liabilities, and Owner's Equity presentation lecture. If you haven't already done so, please make sure that you download the demo problems, which we will be going through as we go through the presentation lecture, and then also make sure that you have access to the Chapter 4 notes. Those will come in handy as you're jotting things down as we go through the Chapter 4 material. All right, so let's get started. In section 1, we will be looking at exclusively accounts and the double entry accounting system. So let's take a look and see exactly what these two aspects of accounting are. First of all, let's take a look at the account. The account, all accounts that are used in accounting are stored in what's called a ledger. A ledger is a book or file containing a separate page for each business account, which is going to serve as a permanent record of financial transactions. So a ledger is an area where all of the accounts are kept, as well as all of the running balances of those accounts. All of those accounts can be accessed by taking a look at a list, which is known as a chart of accounts. This is a list of all of the accounts and their assigned account numbers. Might be hard to picture this in your head, so let's take a look at a chart of accounts and see what it looks like. An example of a chart of accounts is right here. This is what we got. We have assets, we have our liabilities, we have our owner's equity, we have our revenues, and we have our expenses. Now, I'd like for you to notice that all of the accounts also have account numbers assigned to them. Assets will always be numbered in the 100s. Liabilities will also always be labeled in the 200s. Owner's equity will always be labeled in the 300s. Revenues will be 400s. And expenses 500s. All right, at this time, I'd like for you to take a look at demo problem 1, read the instructions, and complete the demo problem. Please pause the presentation lecture as you complete the problem, and we will go over the results the next time that we meet in class. All right, double entry accounting. What exactly is double entry accounting? It is a system of record keeping in which each business transaction affects at least 2 accounts. Now, in more complex transactions that we will be going over later on in the semester and in the year, you might have a transaction that's going to affect more than 2 accounts, but it will always affect at least a minimum of 2. In order to take a look at how accounts are transacted, what we'll do is we'll use T accounts. And a T account shows the dollar increase or decrease in an account that is caused by a business transaction. In a T account, and in accounting in general, anytime an account is affected by a business transaction, the account will either be debited or it'll be credited. If we debit the account, the amount is going to be entered on the left side of the T. If we credit the account, the amount will be entered on the right side of the T. Here's an example of a T account. In order to set up a T account, on the top of the T would be the account name, and then the left side would represent all debit transactions to the account, and on the right side would represent all credit transactions to that account. So each account, when it is affected by a transaction, will either have to be debited or credited. Now, the rules of debit and credit, the rules are going to vary depending upon if it's an asset, a liability, or an owner's capital account. One thing you need to remember for all T accounts, the normal balance is always going to be on the side used to record the increase to the account. So if the debit increases the value of the account, the debit side is the balance side. If the credit side is used to increase the value of the account, then the credit side is the balance side. All right, let's take a look at rules for assets. Assets are debit side balance, which means that we increase them by debiting them on the left-hand side. We decrease them by crediting them on the right side, meaning the normal balance is the debit side of the account, of the T account, which is also the increase side. Now, liabilities and owner's equity accounts are just the opposite. You increase the account by crediting the account on the right side, decrease the account by debiting the account on the left side, meaning the normal balance now is a credit side balance for owner's equity or owner's capital and liability accounts. Now this is an accounting wrap video which will help you determine how to transact in T accounts. It is a little bit corny, but it does reinforce the concept of what the T account is. And we'll be watching this tomorrow in class. Or I'm sorry, the next time that we meet, we'll be watching this in class. All right, in review of section 1, you need to be able to answer the following questions. In a chart of accounts, why are the accounts numbered? If you can answer that, you've got a pretty good gist of the chart of accounts. And then, why is the normal balance side of an asset account on the debit side? If you can answer that, you've got a pretty good understanding of the T account and how and what its purpose is. Let's take a look at a transaction. During the month of December, Krusty's Pizza purchased computer equipment. Now, according to your records, Krusty's Pizza took approximately $5,000 from cash to purchase the computer equipment. Prior to that purchase, the owner's capital account had a credit balance of $10,000. So let's take a look. What is the balance in the owner's capital account after the purchase? Well, if we are purchasing computer equipment and we're paying for it with cash, the capital account is not being used at all. Therefore, the capital account balance will not change at all. It will remain a $10,000 balance. Is the owner's capital account balance a debit or a credit? Liabilities and owner's capital accounts are all credit side balances. Therefore, this owner's capital accounts will have a credit side balance. Just going to breeze through these slides because they are duplicated. It's a mistake. Let's move on to section 4.2, applying the rules of debit and credit. Let's take a look at some transactions. On October 1, Maria Sanchez took $25,000 from personal savings and deposited that amount to open a business checking account in the name of Roadrunner Delivery Service. So the first thing that you want to do is determine the account that is going to be debited. The account that is going to be debited should always be listed first on the left-hand side. So in this case, we are going to debit cash for $25,000, and we would credit Maria S. Capital for $25,000. Notice how both accounts are going to increase in value. The asset debit $25,000, the owner's equity credit $25,000. On October 2nd, Maria took 2 telephones valued at $200 each from her home and transferred them to the business office as office equipment. Office equipment and Maria S. Capital are the 2 accounts affected in this transaction. We will increase office equipment by $400 with a debit. We will also increase Maria S. Capital by $400 with a credit. On October 4th, Roadrunner issued check 101 for $3,000 to buy a computer system. Computer equipment and cash in bank are the 2 accounts affected by this transaction. We will increase computer equipment with a $3,000 debit, and we will decrease cash with a $3,000 credit. Now, if you can picture in your head the accounting equation, assets equals liabilities plus owner's equity. Anytime that you have a transaction where you might have 2 assets that are affected by the transaction clue, both of those accounts are going to operate on the same side of the equal sign of the accounting equation. They're both assets. Therefore, to keep the equation equal, one asset must increase, one asset must decrease. If the accounts that are being affected by the transaction clue are on opposite sides of the equal sign, for example, an asset and a liability, then both of the accounts have to either increase or decrease in order to keep the equation equal. Just some food for thought as you're going through and analyzing these transactions. On October 9th, Roadrunner bought a used truck on account from North Shore Auto for $12,000. Therefore, we will debit delivery equipment and credit North Shore Auto. Both accounts are going to increase. We debit delivery equipment for $12,000. We credit North Shore Auto for $12,000. On October 11th, Roadrunner sold 1 phone on account to Green Company for $200. So now we're making a sale to a customer, which is known as an account receivable. And we are making a sale to them in the form of office equipment. So therefore, we are going to sell this phone to Green Company, who is going to pay us later. So they're going to owe us $200. So we are going to increase our asset $200, Green Company, and decrease our office equipment asset $200 because we're giving them a phone, which is at $200 in value. So debit Green Company, credit office equipment. On October 12th, Roadrunner mailed check 102 for $350 as the first installment payment due on the truck purchased from North Shore Auto on October 9th. So therefore, we are going to debit North Shore Auto and credit Cash and Bank. We are making a payment on a liability balance that we owe. Therefore, we are going to decrease the amount that we owe to North Shore Bank or North Shore Auto by $350. We made a payment out of cash, which means we are going to decrease cash by $350 also. On October 14th, Roadrunner received and deposited a check for $200 from Green Company. This check is full payment for the telephone sold on account on October 11th. So now our account receivable, our customer who owed us money, has now paid. Therefore, the money is received, so we will debit Cash and Bank, and we will credit the accounts receivable Green Company. We now have the cash, so it's going to go into our Cash and Bank, increasing the Cash and Bank balance. And now accounts receivable does not owe us $200 anymore, so we are going to decrease the amount that Green Company owes us. Credit the account $200. Okay, and this concludes the transactions and the presentation lecture for Chapter 4. Please make sure that you go back and review the slides if needed to get the notes and complete the demo problems. And I will see you the next time that we meet in class.